This week, we're speaking with a PhD who works on a day-to-day basis in helping people make better wealth decisions by using investor psychology and behavioral finance to help them help themselves. Stick around. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, my guest is Merle van den Akker. She is a senior product manager at a large Australian financial institution, and she conducts research on how to best understand and how to support customers in their financial journey, with specific focus on investing. She has a PhD in behavioral science from the Warwick Business School. Merle, how are you today?
I'm all right. It's nice and early over here. How are you?
It's late in the day over here, so it's great that technology allows people to connect from all over the world. Can I ask you to begin by please just sharing a few moments about your journey? How did you come to be a behavioral scientist? What drew you to it, and what do you find rewarding about it before we get into specifics?
Oh, wow. That's not exactly a small question, but I'll do my best. So I've always been fascinated by psychology. I think a lot of people who are drawn to psychology specifically have a variety of reasons for it, but the one that I tend to come up against is just a complete lack of understanding what the people around you are doing, thinking, and why they're doing what they're doing. And it was absolutely the same for me. Still completely struggle with it, but it has gotten a bit better. So I always knew I wanted to do psychology. And then my dad was an economist. And, I definitely had that rebellious phase as a teenager where I was like, I'm not going to be like my parents. I'll never be an economist like you, Dad. And then, let's say 1 year into the undergrad where I did a little psychology, I then did realize that for me, the most interesting application of psychological insight is actually to economic and financial decision making. So about half an economist. And I just integrated into my undergrad. I did my master's in it. I then did my PhD in it. And I then moved on to the applied side. So thanks, Dad, I guess. It stuck with me from relatively early on. And I absolutely love it.
I had a similar story. I did a master's in public administration and learned a lot about traditional economics, and became a financial advisor over 30 years ago. And my mother did something similar, but she ended up doing her master's in psychology. And I came to realize as I went further in my journey in giving advice to retail clients that a lot of it is exactly what you just said. A lot of really good decision-making in personal finance is psychological. And I came to realize that I should be maybe spending less time working on numbers and ratios and other empirical things and deal more with what might be called the soft issues, the human side of things. I think a lot of it is just behavioral, and being behavioral means understanding other people and their proclivities at any rate. So I think there's a natural connection between the way you look at things and the way I do. Let's begin by talking about the barriers to investing. What do you see as being the most prominent barriers to being a successful investor?
I think the core barrier is just starting, and that is hugely culturally determined. I think if a lot of your listeners are American, for example, their barriers are going to be quite different from the people here down in Australia, where I'm currently based. And the thing is, the main cultural predictor, if you will, is just how much people have money available to invest. It doesn't sound very cultural, but give me 1 second to explain that. Because here in Australia, and America has it to some extent, but I think a lot less so. But the money down here in Australia is in bricks. As in, this is a complete cultural phenomenon where your parents, of course, if to the extent that they can, of course, will support you buying your first investment property. People here are quite likely to, of course, within their economical abilities, to own an investment property before they even start saving up for their own home. The banking system is geared towards it. There are quite a few tax breaks for people who own investing properties that you may not get if you are a homeowner occupier. And as such, it's just the idea of wealth or starting to mature and starting and kicking off your wealth journey is all purely in bricks. So if you're then looking at stock market investing, that doesn't really tend to show up for the average Aussie until they have an investment property secured, one, and then two, have made a really decent chunk in their home, like mortgage, or are really on the journey towards that asset. And then, towards the end of that journey or somewhat throughout that journey, if somehow putting money in an offset account or just doing some real damage on the mortgage is no longer as attractive and we don't want a second investment property, then maybe the stock market may poke its head around the corner. And I just don't think that really translates well to what you see in a lot of other countries and cultures. So in Australia, the true question is, how do you get someone to start? And unfortunately, as we've seen over the past years, the best way to get someone to, really consider investing in the stock market is unfortunately to take the dream of home ownership, even if it's an investment property, away or make it significantly more difficult, or at least really mess with the time scale in which that can become achievable, which we have seen here as rates have increased. And for your audience, if they're not familiar with the Australian market, with how expensive housing has become, as realistically, there's only 5 cities in Australia people actually want to live.
Well, so it's similar for me. So I'm based in Toronto, Canada, and in Toronto, and I was just in Vancouver last week. And in Toronto and Vancouver, those 2 cities are dealing with real estate prices that are astronomical. When you look at on the global scale, they're both, I think, 2 of the top 10 cities in the world in terms of real estate prices being out of reach. And I don't know, there may be 1 or 2 Australian cities there as well. But
I'm
really
sure.
Yeah, it really is becoming a really bifurcated market, as you say. So in Canada, a lot of people, it's gotten to the point where housing is out of reach for the generation that is, let's say, 30 years old, increasingly even 40 years old and under. Mm-hmm. And as a result, they invest in the market because they physically cannot get access to real estate at any price at any point in time. I don't know that it's that culturally different. I think one of the things that we have to realize is that real estate prices being high is a phenomenon that's being seen throughout much of the Western world, and it's a constraint everywhere. Okay, so let's talk about risk aversion. Let's work on the assumption that the person you're talking to is going to invest in the market, the stock market, or in stuff other than bricks. And it's funny because when you mentioned bricks, I thought maybe you meant Brazil, Russia, India, China as a subset.
Oh, no, sorry.
So bricks and mortar is what you mean. But if a person is going to invest, maybe you've got some thoughts about risk aversion. I'm curious to hear what you have to say about that.
No, I think risk aversion, as literature has shown time and time again, is of course a huge predictor for whether someone is comfortable to start investing. What I find really interesting with the idea of risk aversion is that it is very, very difficult to understand how much of a risk taker or avoider someone is before they have ever invested. I think there's a lot of scales, rate yourself like from 1 to 10. How risky do you think, you'd like your investments to be, or more of the short term, the more composure-esque measure, like, hey, imagine that your portfolio has just dropped 20% from one day to the next. What are you going to do? The thing is, these kinds of questions, although they're pretty decent measures, like they do have a high enough correlation to kick you off and to get some insight into yourself or into your client, they are really bad predictors for what someone is going to do over the long term once they learn about investing, once they experience investing. Because we know this from basic exploration method, you really don't know what someone is going to do until they're in it. And this is, investing is a really, really good example of that. It's just unfortunate that investing can be a very costly example of that if you've really misunderstood your own or your client's psychology. So in terms of risk attitude, people that have started investing, that have been invested, especially more active investors, the longer they invest for, the more their risk attitude changes, the more they become at least risk neutral, some of them even risk seeking, depending on how active you trade and, of course, how successful that trading has been. But even the average passive investor, if they just go through the motions and see how the stock market tends to change, they don't act on it, but they just take note of what's going on. That is also a person that increasingly shifts their own risk aversion. So despite the fact that a lot of people, at least over 3/4 of the world, has what we call risk aversion in one domain or another, informed risk neutrality or informed risk seeking is absolutely not as dangerous or as uncommon as it sounds.
Okay, so let's see if I can ask you to make an important distinction. What is the distinction between risk aversion and specifically loss aversion?
So loss aversion, it is just generally the idea that any loss at whatever rate it may occur needs to be avoided. Now, of course, within investing, risk aversion and loss aversion are very, very similar in nature because the risk of investing is loss. Now, is somewhat risk averse need not be loss averse, because the idea of loss aversion really is that you don't want to sustain or incur any loss. The thing, of course, with investing is as long as you don't lock in your losses, as long as you don't sell against the loss, you haven't really lost anything. So very often it just tends to be the horizon that someone acts on, or that someone takes into consideration, which if a loss-averse investor, as soon as the loss is incurred, that's a very short-term horizon, and they will unfortunately have a not so great experience. Whereas someone who's risk-averse could still make the argument, well, yes, my portfolio has fallen X% over the short term, but I, through financial education, through experience, through guidance, know that this is a short-term blip. Yes, I'm currently uncomfortable, but I won't act on it. I won't lock it in. I won't suddenly start making weird jumps to get out of this loss, becoming incredibly risk-seeking all of a sudden, for example, to offset the losses.
Could I ask you to maybe add a little bit about prospect theory? Because we're dancing around prospect theory. We haven't actually spoken about it. And frequently when I have guests on, I'm the one who has to explain it. But I would rather have you explain prospect theory because you can probably do a better job than I can.
I mean, I can't make promises I can do a better job. It's been a while since I've read the original papers. I mean, it's been a while since they've come out. But the idea of prospect theory is really that people act very differently when they are faced with either a gain or a loss. Within the domains of gains, people like to lock in their gain. They are risk averse to the extent that as soon as a gain or an opportunity to lock in a gain has presented itself, people will act on it. Even if, and this then is the disposition effect, which is based off prospect theory, even if the idea of locking in that gain right now, the only real value of that is that you're not going to be able to continue locking in gains from a similar asset because you've already sold it. Now, the other side of the coin here is that in the domain of losses, most people, despite the fact that on average they are risk avoidant, that they do end up becoming risk-seeking in the domain of losses because people really don't want to incur a loss. Now, when we're talking gains and losses, really what we're saying is that this is a gain and or a loss depending on, unfortunately, an endogenous reference point, meaning that it really depends on the individual what that reference point may be. For the average asset, likely it's going to be whatever value it was purchased at. A lot of investing apps, for example, they do tell you how much that you've gained on the asset since purchase. So this total increase, whether that's monetarily or relative. But the reference point could honestly be a variety of things. It could be the price a friend of yours sold it for, or a price someone else is aiming for. It may be a goal amount of value. For example, you bought a stock for $100, but you want to get it to 200, or you'll only sell if you double it. If the stock is now at 180, despite that being an 80% gain, it could still be felt as essentially a 10% loss because it's not at 200 yet. So it's really difficult to understand how people treat this reference point. But yeah, the essential idea is just that when it comes to gains and losses, people do treat them significantly differently. There's also the saying that just looms large over every behavioral scientist's head that losses hurt twice as much as gains feel good. That saying is very largely debated, but we can just make the argument that losses are experienced very differently from gains, and people act very differently when faced with a loss than with a potential gain.
Okay. And it should be anybody listening, the people who did this research are named Daniel Kahneman. Her name is Tversky, and Kahneman won the Nobel in 2002 and wrote a book called Thinking Fast and Slow, which was an international bestseller 10 or 12 years ago. Passed away recently. Tversky, unfortunately, didn't win the Nobel because he died, and the award is not given posthumously. But Thank you, Merle. That was a useful explanation. And I frequently, when I tell the story, I tend to focus on the contentious pains or twice as firmly felt as the gains. And I don't often go into a lot of detail about reference points and the like. And I'm glad you did, because it's worthwhile. What about other financial priorities? What would you say are the other financial priorities that people should be thinking about from a behavioral perspective, and maybe one or two hacks as to how to better focus on that?
I mean, it really depends on where you are in life stage, and also just the culture around you that you have with regards to money. I think the one thing that we do notice, and this holds true for investing, so I'm sure this holds true for other aspects as well, but most monetary decisions are really quite social in nature. So we look around us to see what other people are doing, or at least what we think they're doing, because it's very difficult to look inside someone's mind and or their bank account. So we tend to look at others. And one of the biggest predictors of whether people do end up investing, so whether that's in Australia or any other country that doesn't have this obsession with bricks and mortar, the real predictor is whether someone around you is investing. Because this is someone that can talk you through the process. Investing as one of the financial aspects, one of the financial steps to take, is one of the more complicated. I think it's one that is very often hid behind a lot of jargon. I do think that it's largely on purpose, but hasn't done anyone any benefit. And people find it too complicated. Risk aversion, loss aversion, they are huge concerns when it comes to investing, but so is just a lack of basic financial literacy, which I think the average education system has failed us all to instill a basic sense of financial literacy in us, which is very unfortunate. So we see this with investing, that people really care for social guidance. And given that this is true for investing, it is also true for how people spend their money. If everyone around you never discusses savings, but they do discuss how much they put on the Amex, or they discuss how much they spend on an average weekend going out, and these are truly astronomical numbers, well, that becomes the new normal. I'm not saying this is the new normal for most people. I think in the current economic climate that we are in, the new normal is barely getting by, as wages have not kept up with anything else in the world. But it's an interesting one where we simply look towards others as the financial domain or sound financial decision-making is just a big question mark to the average person, because you don't get taught it, and you look around and you hope that will resolve the ambiguity for you. And sometimes it does so very well. You know, if your dad is like mine, is an economist, that can work out quite well. But if your dad isn't, or if no one in your family or in your direct circle is responsible with money, this can become a very bitter pill to swallow and a very difficult lesson to have to learn throughout other avenues in your life.
Okay, so we've been dancing around something that I would love to hear your thoughts on, and that is the idea of a nudge. And we were talking a moment ago about Kahneman's work. There's a guy by the name of Richard Thaler, also an economist who has won a Nobel Prize. And he wrote a book along with another guy named Cass Sunstein called Nudge. Again, I'm going to say maybe 8 or 9 years ago. Its second edition came out a couple of years ago. And it talks about
I actually think Nudge is older. I think Nudge is from 2008, 2009, the original.
Really? Okay.
Yes, old.
Oh, boy. Okay. So Nudge came up before thinking fast and slow. That could be. And yeah, I think you're right. At any rate, could you maybe talk about the idea of what a nudge is? And if you can think of a couple examples, maybe you can share them with us.
Yeah, absolutely. So a nudge is essentially a change in choice architecture design, which sounds really fancy, but it really just means that it's a small tweak in whatever environment you're in that you need to make a decision in as a citizen, as a customer, as a consumer, but potentially even as a practitioner or as a policymaker. Some people do nudge themselves, and the nudger can get nudged. So and examples of that, there's the very famous early noughties study on organ donation. If you change the default in a country to become an opt-out default, meaning that everyone is automatically enrolled in being an organ donor, of course, you can still opt out. The opt-out process is not hard whatsoever. But this is the idea that, you're automatically enrolled, and as such, the enrollment rate is significantly higher. And that 2002 paper, if I'm correct, show that countries that had this opt-out default were simply much, much better at keeping these rates very, very high, whereas countries with an opt-in policy had very, very low sign-up rates. Now, it does have to be mentioned here that it is specific that it is the sign-up rates that were high. They have done longitudinal studies on whether this actually really increased how much organs got donated, and the evidence on that is a bit shaky. But there have been, and of course, this does make sense with regards to organ donation, as this is a highly, highly sensitive topic, and not everyone is as comfortable as you could be. And there may be moral, ethical, and religious, potentially even philosophical reasons as to why people would not want to participate, which is, of course, completely valid. In the financial domain, specifically sticking with the idea of a default, there is, because you've already mentioned Richard Thaler, together with an old colleague of his, Shlomo Benartzi, they also wrote I think this is also a 2004 paper. So 2004 was clearly a great year for the default. They wrote a paper essentially called SMART, which is an acronym for Save More Tomorrow. Just jumble the letters a bit differently and you will get to that acronym. But the idea was that they actually merged a couple of nudges to get people in specific manufacturing companies, so mid-sized American manufacturing companies, to actually, first of all, automatically enroll into their pension savings program. But then the second additional automatic nudge was that for every pay increase, they would also increase their contributions to their retirement. People could opt out of this at any stage. They could also do it themselves. They could also have a chat with a financial advisor who would talk them through it. They could just do lump sum contributions to their retirement account. The options galore. But the default was you're in this program, followed by a default. And then once you're in this program, every pay increase you get. And this is why it's quite important that this was a manufacturing company in the late 90s, early 90s, because they had very strong, very predictable payment plans. If you produce a certain thing, if you were with the company for a certain amount of years, you did get that pay increase. So it's a very predictable process, bit different from other sectors. So, the people, the employees knew exactly when these pay increases were coming, so they could have absolutely emulated SMART themselves. It's just that the majority of people, through inertia, through temptation, through just having so many other things on their mind, don't. And this is really when defaults really hold a lot of power. If it's simply a decision that you do want to make, but that you're never going to get to, it is better to outsource it, here to the system or to the nudger if you're even comfortable with the system and or the nudger. So what they saw is that for people who did enroll in SMART fully, they, after 4 years, did have the highest savings rate for their retirement. I think for the average employee, it did kick up to about 13.5%, if I remember that number correctly. Whereas for people who contributed a lump sum up front, I think that number sat around 9%. And for those that were just trying to manage it themselves, I think it was somewhere between 5 to 7%. So like a strong difference in contributions made on a relative scale. So yeah, that's a strong nudge.
It's a strong nudge. So it's one of those little benefits of what you say is choice architecture, how you just designed the questionnaire, the opt-in, the opt-out, getting a pre-commitment to do things that you say you wanted to do, but for whatever reason, life gets in the way and you don't get around to doing it. These are all ways that we can enhance the investor experience and the investor outcome, because a lot of people self-sabotage. Sometimes it's unwitting. And sometimes it's socially motivated because you're trying to keep up with your neighbors and they went out for dinner on Friday. So I want to go out for dinner on Friday as well, and so forth. But I think it's great that we are finally in the 2020s making, I would say, some degree of progress with regard to how we can marry economics and psychology to get better outcomes for investors. If it were up to you, what would you say would be the 2 or 3 things that can be done for the average investor to help them have a more successful investor experience? Is there anything you can think of off the top of your head that, geez, if, whether you're working with an advisor or not, if you could just do these things, you're likely to do better?
Oh, if you have experience with investing, automate the whole lot.
Okay.
It's maybe it's an interesting recommendation. I mean, I've been investing for a long, long time. Again, blame my dad for it. I also find it really interesting, but also I'm of the generation, as you've already mentioned, that just can't afford a house. As a stock market, here I come. So if you have experience, I do generally think that the average, and this is not a huge promo for any particular robo-advisor, but if you've got experience and you know what good looks like or what it should look like, I generally think there's a lot of value in automating a whole chunk of it. Like the average robo is very good at understanding when a portfolio is completely skewed, when it needs to be rebalanced, and just really when things have gone a bit out of whack. And there may be a variety of reasons why you as an individual investor may not want to act on, standard economic theory or what the robo is recommending you or what anyone around you is recommending you. But that is largely a biased decision, and it is very difficult as a singular human being to get over all of your biases. We have seen this time and time again, and it's okay to know that the decisions that we make in the financial system that we're in are, I don't necessarily want to say flawed because I don't like the idea of flawed decision making, but the system and our internal system, are not compatible, and that's okay. It's just the truth, but it's best to work around that or work with that rather than try to work against it. For those that don't have any experience, start. The best way to learn more about it is to be in it. Now, I'm not saying throw your entire fortune at it, but there are quite a lot of simulators that you could practice on. You could even track an imaginary portfolio. Had you invested $100, what would that have looked like? What would you have done? And you can track that throughout as well, to see, how you go with it. You don't immediately have to put your money where your mouth is, but you do have to make some semblance of a start. So I think when it comes to investing, it's for beginners, for rookies, get your hands dirty. And for those properly in it, if your hands are maybe sometimes getting a bit too dirty, maybe automate some of it away.
All right. This has been wonderful. Merle, I want to thank you today. This has been a wonderful conversation, and I'm really glad that we got a chance to cover off some of the things that I talk about with people where I'm speaking with a practitioner who doesn't necessarily know the science of behavioral economics, and you clearly do. And I'm very, very grateful for you taking the time to share with me today, and I want to wish you all the best.
Thank you so much for having me, John. It was absolutely lovely.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.